In 1889, German Chancellor Otto von Bismarck invented modern retirement. He set the retirement age at 70. The catch? The average life expectancy back then was only 45. It was a genius mathematical scam. Bismarck designed retirement specifically so most people would die before they ever collected a single dime of government pension. Yet today, we are still using that exact same 130-year-old blueprint for our financial freedom. And the reality is, the system is fundamentally broken. The traditional retirement model is a lie. To understand how we got trapped, we have to look back at the sudden death of the corporate pension. Before the 1980s, companies paid you to grow old. You gave them 30 years, they gave you a golden watch and a guaranteed check. But in 1978, a subtle tax loophole changed everything. Section 401k of the Internal Revenue Code. It wasn't designed to replace pensions. It was written so corporate executives could get tax-free bonuses. But Wall Street saw an opportunity to offload all the risk from the employer straight onto the employee. They told us, take control of your own destiny. Just buy mutual funds and watch them grow. And just like that, the corporate safety net vanished. We became our own hedge fund managers overnight. Except most people don't know how to hedge. They just hope the line goes up forever. Which brings us to the famous 4% rule, the absolute holy grail of modern financial planning. Created in 1994, it says if you withdraw 4% of your portfolio annually, your money will last 30 years. But that rule was built for a world that simply does not exist anymore. Back then, bonds paid 6% guaranteed. You could literally sit on cash and beat inflation easily. Today, thanks to decades of central bank intervention, money printer go borrower is the default setting. This massive currency debasement has completely destroyed the purchasing power of your retirement savings. Think about it. $1 million in 1990 bought a mansion. Today, it buys a modest suburban home. If you have $1 million saved today, a decade of 5% real inflation will cut its value in half. The real math is brutal. To survive a 30-year retirement today, you need at least 3 times what you think. But wait, it gets worse. Let's talk about the giant demographic time bomb of Social Security. In 1940, there were 42 workers paying into the system for every single retiree receiving benefits. Today, that ratio has collapsed to just under 3 workers per retiree. The math simply does not compute. It has turned into the largest legal Ponzi scheme in human history, relying on an expanding base that no longer exists. And when the base shrinks, the promises must be broken. Either retirement age goes up or payouts go down. So if the old rules are completely dead, what is the average person actually supposed to do? First, we must accept the truth. The idea of stopping work at 65 is a historical anomaly. For 99% of human history, people worked as long as they were physically able. The goal shouldn't be to do nothing. The goal should be to do exactly what you want on your own terms. To do that, you have to transition from saving depreciating cash to acquiring high-quality hard assets. Why? Because paper currency is designed to lose value. It's a melting ice cube in a warm room. Hard assets, like real estate, cash-flowing businesses, and scarce digital assets, cannot be printed away. Look at the ultra-wealthy. They don't have massive savings accounts. They have massive asset portfolios. When the central banks print trillions, asset prices skyrocket, making the asset owners incredibly rich, while the person holding pure cash is left holding a bag of depreciated paper. So the first shift is psychological. Stop thinking about your net worth. Start thinking about your cash flow. Can your assets pay your monthly expenses without you having to sell them? That is true wealth. If you have to sell your assets to buy groceries, you are still at the mercy of the market's wild mood swings. And trust me, the market is a manic depressive monster that doesn't care about your grocery bill. The second shift is embracing global alternative markets, including decentralized finance. Crypto isn't just a casino anymore. It's a parallel financial system built on absolute scarcity. When the rules of the traditional game are rigged against you, playing a different game is the only logical move. But warning, do not jump from one extreme to another. Going all in on speculative assets is financial suicide. The key is asymmetric risk, small bets that have massive upside while protecting your core capital. We are entering a multi-decade transition period.
where the old financial map is completely useless. If you try to navigate a digital storm with an analog compass, you are going to sink. You must build a personal sovereign economy, one that doesn't rely on the promises of politicians. Because at the end of the day, a government promise is just ink on paper, backed by unpayable debt. So let's strip away the lies. There is no magical age where you suddenly stop and everything becomes free. The golden years of sitting on a porch doing crossword puzzles was a brief 30-year historical fluke. The future belongs to the active, the agile, and those who build multiple streams of independent income. It's about intellectual longevity, keeping your mind sharp and your skills highly valuable. You don't retire from life. Retire from the bad deal of trading your valuable time for rapidly inflating paper. Invest in your health, invest in cash flowing assets, and embrace the parallel economic system. The road ahead isn't a straight line anymore. It's a winding path through a complex financial jungle. But if you drop the 130-year-old lie, you can finally start building real, lasting freedom. The choice is yours.